The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender at MLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And our Sunday best to you. Good morning and welcome to the Accunet Mortgage and Realty Show here on 620 WTMJ. I'm Steve Kettlear, along with Accunet Mortgage and Accunet Realty Advisors owner and president Brian Wickert and licensed millennial loan consultant David Wickert. And as always, if you have a question, you can give us a call at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620. I'm going to be curious to see what devil in the details little nuggets you got from this Wall Street Journal story that leads people to believe that more people were backing out of offers in 2016, and that is just not true. But we've got some fast-selling municipalities here in southeastern Wisconsin numbers to look at for last year.
You bet. The two are related, I think, and let's start out with that because it's something that we didn't get a chance to get to last week's show. So I looked at all the condo and single-family home sales last year in 2016, and you might remember it was a great year. Condo sales were up a very impressive 9.3% in 2016 versus the year earlier, which wasn't a slouch year in and of itself. No, not at all. 2015 was a good year. Single-family homes were up 6%, which meant 1,007 more single-family homes sold in 2016. So very strong. So now what I wanted to get to, I took a look at just single-family homes where we had at least 100 sales for the whole year. All right, and this is me looking at and grinding the numbers from the Greater Milwaukee Association of Realtors, which I am a member of, and their multiple listing service database. All right, so I am the data cruncher here. And what I looked at is continuous days on market, which means if you listed your house with Realtor A and then you switch to Realtor B, it takes a look at the total number of days, not just, with the one. Something else, by the way, that real estate agents will do sometimes is they will give you a new MLS number. And the reason that they'll do that is that it makes it look like your house is new again. So this data that I'm using is supposed to see through that trick as well. So it's called continuous days on market. All right, so you're ready. And I did this kind of like a golf tournament where I grouped them. So in number 10, Grafton and Heartland took 2.9 months to sell. In ninth place, we have West Dallas, Cedarburg, Glendale, and Mukwonago at 2.8 months to get from listing to accepted offer. Number 8, surprising, Brown Deer and Franklin.
The old BD.
The old BD, Brown Deer at 2.7. In seventh place, we've got a big gaggle of ties there. Whitefish Bay, South Milwaukee, Jackson, Menominee Falls, Port Washington, and Shorewood, all logging in at 2.6 months. My hometown, Muskego, along with Lisbon, tied for 6th place at 2.4 months. We've got Greenfield and Waukesha at 2.3 months for marketing time. That's 5th place. In 4th place at 2.2 months of marketing time, Wauwatosa, Brookfield, and Greendale.
I believe that.
Getting down to it. Okay, yeah. Wauwatosa, frequently mentioned as a fast-selling area. And 3rd place, all by itself, is Sussex. That one was leading in some of the months when we talked. 2nd place, G-Town at 1.9. That's short for Germantown. Oh, yeah, you knew that.
G-Town.
G-Town.
G-Town, baby. And tied for 1st place. Okay, David, did you?
I think, is it New Berlin?
New Berlin is tied with Oak Creek.
Really?
At 1.8 months. Okay. So it took on average 55 days to go from planting that for sale sign in the front yard to getting that accepted offer. So 1.8 months, not bad. It's still not 2 seconds.
No.
Yes, there are some where we have multiple bids coming in. What happened on that transaction last weekend, David? We talked about you jumped in there on a Saturday, cranked out a rock-solid pre-approval for a guy who had a flimsy big bank pre-qual letter that the realtor saw right through and said, we needed rock-solid. Did he get the bid?
Absolutely. And they walked in with their rock-solid. They were about as rock-solid as it comes.
Okay.
So it made that real easy, and they got the accepted offer on Monday, and I think, I'm biased, but I think that rock solid helped that they didn't just go to mortgage.com and print off a pre-approval letter.
It certainly didn't hurt. All right, when we come back from this first break, this is the headline that appeared on January 11th in the Wall Street Journal. More home buyers backed out of offers in 2016. Is it true? We're going to give you our take on the numbers when we come back.
And as always, if you have a question, you can ask Brian or David at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, you hear him every game day. His voice has become synonymous with Packers football for an entire generation of fans. But what was it that led him to Lambeau almost 2 decades ago? Wayne Larrabee steps outside of the broadcast booth to join Packers One-on-One with Greg Matzik. And you can hear that conversation coming up at noon today, sponsored by Pella Windows and Doors of Wisconsin, New Generation RV, and Sound Decisions Racine. It is 10:17. We're in the midst of the Accunet Mortgage and Realty Show. Brian Wickert, David Wickert with us. And now the debunking of this Wall Street Journal headline.
Yes, and it's going to debunk you in a surprising way, Steve. This is January 11th article by Stefanos Chen, where the headline was more home buyers backed out of offers in 2016. David,
let the record show newspapers are in the headline business, so they got to get people somehow. But go on.
Okay, well, I'll go with that. Last year, according to the sub-headline, according to the Wall Street Journal article, last year 3.9% of potential home buyers backed out of the deal before closing. This is according to a Trulia analysis. And then furthermore, and this is so hilarious, Akron, Ohio tops the list of luxury buyers who got cold feet. All right, so which thing should we take first? I want to go right to Akron, Ohio.
Go ahead.
Okay. The luxury market in Akron, Ohio, according to the article, the median price of a luxury home in Akron. Are you ready?
Yeah.
You're sitting still. Let me just preface this by saying the median price of any home in the Milwaukee metropolitan area, single-family detached, is $200,000.
Okay.
The luxury market in Akron is $274,000.
Okay.
So
buy you a lovely home.
Yeah. So right away, that's a red flag for me. All right, but here's the other thing. 3.9%. Think about that. 3.9%.
So out of 100 people, out of 100 transactions, 4 of them
don't make it to the closing table.
Okay.
By the way, they say that in the first-time home buyer market, or the lower third of the price range, 6.3% of buyers don't make it. That's up from 3.4% last year. And they hypothesize, well, these buyers are more likely to hit financing hurdles or underestimate closing costs.
Or my favorite word, tight underwriting standards.
We're going to get to that in a hot minute in another segment from another article that we came across this week. But I am calling BS, as in bologna sausage, Mom, not the other one. Bologna sausage. These numbers are bad. What, Steve? What do you think? Do you think that? Let's call it 4%. Do you think that number sounds high or low to you in terms of number of failed transactions?
That sounds high.
Hi, Dave.
I just think it sounds normal that 4 out of 100 people just decide, I don't want to keep going.
All right, well, I got bad news for everybody. I decided this morning to look into the last 1,200 purchase applications that your friends at Low Overhead Accunet have gathered. That's exactly 2 years' worth of purchase loan applications. And I'm here to tell you that we denied 6% of them. So right away, we're above that number. Oh, by the way, I forgot to mention that in the article, they did publish a really nice, handy spreadsheet, interactive spreadsheet that you can look at. And so they're claiming, according to the Trulia data, that only 0.3%, not 3%, 0.3, less than 0.5% of Milwaukee area transactions, according to Trulia, fell out of bed. Wrong. So I'm telling you 6% fell out of bed because we denied them. 40% of our denials were because of property related. The appraisal came in low, or the appraisal wasn't in good shape, or, the property wasn't in good shape, or maybe it was a condo that didn't cut the mustard.
Yeah.
By the way, just as an industry standard to let you know, mortgage lenders, by and large, figure that if they take 100 applications, 75 will close.
Okay.
So the industry average is a 25% fallout rate. But here's the other thing. 14.5% of the 1,200 purchase money applications that Accunet has taken in the last 2 years have been withdrawn by the applicant. And I don't have the statistic on this because there's only two reasons why a person would withdraw their purchase application. Reason number one is they went with a different lender. That hardly ever happens with us. So I'm going to say that that's, 2%. Mm-hmm. The other 12.5% then, or 1 out of 8, is because the property failed inspection.
Sure.
So I'm calling BS or bologna sausage on this whole article because it's way higher than 3.9%. And I'll do a survey of real estate agent friends and see what they think it is. But I'm calling it 10% minimum, and probably more like 12 or maybe 20%. All right, so there's your debunking of that article. David's got an article from the Wall Street Journal. Tell us about that.
Yeah, when we come back from this next break, I want to dive into the real cost of having waited to buy your home now versus back in the summer. Another article in the Wall Street Journal just talking about the real effects of interest rates when we come back from this next break.
Right here on the Accunet Mortgage and Realty Show on WTMJ.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Milwaukee Area Technical College offers some incredibly unique programs to students and has become a building block in the lives of many. You can hear from MATC President Dr. Vicki Martin when she sits down with our Michelle Richards. It's the next feature in our WTMJ Conversation Series, and you can catch that coming up at 11:07 this morning here on WTMJ, just ahead of Packers pregame on WTMJ. Brian Wickert and David Wickert with us, and David's been looking into the real cost of waiting on a deal.
Because one of the things that I think we take into account is payment, especially when you're purchasing a home.
I would tell you that I think that's the number one thing that home buyers...
Okay, and so this is an obvious statement, but interest rate impacts your payment.
Uh-huh.
Okay, so when you are kind of trying to stick to the same payment and the interest rate moves on you one way or the other, that impacts how much house you can buy. So Freddie Mac, one of the two government-sponsored entities, keeps track every week of what interest rates are. And so this Wall Street Journal article harkened back to, man, when rates were X back in summer of 2016, that has led to a 9%-ish drop in the amount of house that you can buy.
Okay, 9% drop.
So what that actually means is in summertime, Accunet could have delivered, if you put 20% down and all the other right stuff, we could have delivered, wait for it, 3.5% on a 30-year fixed. And now in today's pricing, we could offer an interest rate, in this example, of 4.125%.
Okay, so up a little bit more than 0.5% since the all-time lows of the summertime.
Correct. And so what that means on a dollar-for-dollar basis is that the $250,000 house you could have bought in the summer, if you wanted the same payment, you could buy a $232,000 house.
Well, gosh, David, that's about an $18,000 drop in the price.
Right, which is not absolutely enormous, but it's still maybe that next level of house that is limiting when the interest rate moves on you like that.
And I talked to a borrower just this past week, and, they were looking at a particular house, perfectly happy with their house, but a friend of theirs put a house that they really liked in the same town on the market. They're like, could we buy that house and keep our payment at $1,400? I did the math, and the answer was $1,630 all in is what the payment would be. And they're like, nope, we're out. The highest we want to go is $1,500. And so, frankly, that wasn't really too much a matter of the interest rates going up, but it was certainly a factor. That was more going up in price. But people do have that in mind is, hey, what's my top payment that I want to shell out every month? And part of that equation is down payment. And the other part is interest rates. And don't forget property taxes on that. Well, one thing that is going to help a lot going forward here immediately is that FHA announced that they are reducing the monthly mortgage insurance premium on all the FHA-insured loans. And just as a reminder, an FHA loan is a 30-year fixed rate typically. You can do other types of loans, but I would say 99 out of 100 are 30-year fixed rate loans. And they allow a person to buy a home with as little as 3.5% down, which is fantastic. And it is also accommodative of people who have not the best credit scores. So when we come back after the news here, we're going to talk about exactly what impact that FHA announcement is going to have on home buyers in 2017, because it takes effect immediately, which is terrific.
Oh, and don't forget, FHA is also raising their top loan amount as well.
Okay. All right. So we got all kinds of news.
The double benefit.
All right. So when we come back from the news, we're going to talk about those three lovely letters, FHA.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ. It's now 10:30 on this Sunday morning as we welcome in from the WTMJ 24-hour newsroom, Colleen Bolin.
Thank you, Steve. The executive.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert and David Wickert with us here on WTMJ. So why is now a better time to get this deal done?
Yeah, David was just talking about the Wall Street Journal article and talking about obstacles to home ownership and how people are having to trim back their purchase prices because rates have gone up, 0.5 to 0.75%. Well, here's the deal. We keep getting economic information. This past week, the economic information was an increase in inflation at the wholesale price level, and also retail sales were good, especially online retail sales. The week before that, we didn't really talk about it very much, but we had a good jobs report. All those things are leading the Federal Reserve to pencil in, are you ready, 3 more rate hikes between now and the end of 2017. Nobody expects them to do it at their February meeting, by the way, but it's not like anybody's calling for rates to drop. So, the reasons to wait are probably the only good reason I can come up with is there's not a lot of inventory out there. So just to repeat what we said last week, if you are thinking about listing your house, do it now because there's a shortage of listings. David, you have an
I was just going to say the odds makers, 97% of the betting world thinks that the Fed will not raise rates here in February.
Okay, February. So that's just not going to happen. Did you happen to look up what happened, or you don't have that ready?
No, I do. So, and I think if I understood your question, it's, hey, if you just still bought the $250,000 house, but now it's 4.125% versus 3.5%. The difference in the payment is $71 a month.
Okay, so $71. That's not quite $1,000 a year. That's not going to stop everybody. Some people will still go ahead and buy that home. We have not. Have you seen anybody looking at adjustable rate mortgages yet? No, me neither. So we have that in our back pocket as a go-to. If things get out of hand. Last forecast I saw for 30-year fixed rates was for them to climb to 4.4% by the end of the year. So again, not bad, but why wait? The only good reason I can think of is you can't find.
So I want to do an example of this FHA lowering the monthly MI.
How much did they lower it, David?
They lowered it from 85 basis points to 60 basis points. So that's
what's a basis point? Why don't you say that? It's like 50 basis points is a half percent.
It is that's 1/4 of 1%.
Right. So everybody who is about to get, and literally we had some FHA loans that were about to close.
I had one this week.
Okay.
Yeah.
It's like instantly, that is a 0.25% reduction it's the equivalent of a 0.25% reduction in your interest rate.
Well, and so the example that I wanted to give was the difference between conventional and FHA. So for someone with 690 credit, and you alluded to this, FHA doesn't pass judgment from a pricing perspective on your credit score.
Right. Your credit, the mortgage insurance cost on an FHA loan is 0.6% per year. So a little more than 0.5%, in terms of an interest rate equivalent. And they don't care if you have 590 credit or 800 credit or anything in between. They don't mess with the mortgage insurance premium. That's not true of private mortgage insurance companies. Right. So, David, what's your example?
So for conventional, you can put as little as 3% down, and with the 690 on even just a $200,000 purchase, the interest rate would be 4.375, but wait for it, the APR is 5.4.
Why is that, Dave?
It's because the monthly MI is $226 a month. And what APR is attempting to measure is all of the costs of the loan. So the interest rate is for the interest, but the APR is for the everything else.
Right, includes the upfront mortgage insurance premium. So let's just get that out there. The one disadvantage of FHA loans is that, well, there's two. The first one is that you pay a hefty mortgage insurance premium upfront. So for every $100,000 that you borrow, you have to pay $1,750, or 1.75% of the loan amount.
It's Uncle Sam.
Upfront. But don't worry, you can finance it.
Yes.
So you can plop that on top of your mortgage, which almost everybody does on an FHA loan. So it does eat into your equity a little bit. The other disadvantage is that your mortgage insurance, if you do a 30-year fixed-rate loan, never goes away. That 0.6% is on there forever, unlike private mortgage insurance that does eventually drop off when you get your loan paid down far enough. Luckily, we have both options. And so we can set, what was the total monthly payment difference between the 3% down with a Fannie Mae 30-year fix?
Yeah, it was $187 a month savings if you went FHA versus conventional.
So in the practical real world, if you've got less than awesome credit, we're gonna show you, and you will probably want to seriously consider an FHA loan. Also excellent for duplexes, by the way. Is it 5% down on a duplex, or can you
3.5% on a duplex, as opposed to 15% down for conventional?
Right.
All right. When we come back from this next break, I want to talk about amendment writing.
Okay, we've got some real-life examples that'll scare you when we come back.
Here on the Accunet Mortgage and Realty Show with Brian Wickert and David Wickert.
Expert advice on buying a home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, experts claim that the third Monday of January is the most depressing day of the year. What's behind that claim, and is it really true? The Wisconsin Morning News Crew takes a look tomorrow, Monday, the third Monday of January, here at 5:20 tomorrow morning on WTMJ. We're talking amendments now and how important it is when you're writing those up in a real estate deal. Brian Wickert and David Wickert with us.
So I had the absolute pleasure of an agent calling me this week and asking the question, David, we're writing an amendment, should we do a price reduction or a seller credit? And I said,
this was related to the inspection. So
yes.
This is what we're talking about, folks. Both buyers, sellers, and real estate agents on both sides, please consult with your mortgage lender.
Yes.
Before you finalize the drafting and start circulating around for people to sign, because it can cause problems. So how did this person do it correctly? They called you before or after they drafted it?
Before.
Excellent, okay.
Which was excellent. And so the question was credit or price reduction, and I said 100% do the seller credit for closing costs and prepaids.
Closing costs and prepaids. And then don't put in because of the faulty roof.
Right.
Just
leave
keep
her be.
mum on that. All you have to do is say, seller agrees to provide credit for closing costs and prepaids of $3,500.
And the reason why for these folks, it's going to drop. It reduces the amount of money they have to bring to closing directly, as opposed to lopping off when you did the math.
I did. Yeah. So first of all, David, though, are our closing costs $3,500?
No. And these people actually had selected the no closing cost option.
Okay.
Already.
So what else can you use that money for?
We can cover the first year's homeowner's insurance premium, and from there we can cover the deposit into your property tax escrow account.
Okay.
We can cover the daily accrued interest
from the day of closing until the first of the next month.
Absolutely.
Okay. Or we could use it to buy down the rate if we wanted to. But here's the math. If you take a $200,000 purchase price and you take a reduction in the price with 5% down, it would only lower your payment $19.79 a month on a 30-year fixed rate loan. So what would you rather have? $3,500 in your pocket or a payment that's $20 lower? 99 out of 100 people are going to take the $3,500 cash still in their pocket, because you could literally just put it in the bank and supplement your payment.
Correct.
For 15 years.
Well, and for these folks, they might be putting it into their home, and part of the unofficial math that I did with them was to say, well, hey, what if you took that $3,500 and put in new flooring in your kitchen or, invested in your home? It's like maybe that then builds the value of your home.
Okay.
Not that they're going to sell anytime soon, but that's just money they get to keep in their pocket. Then.
And what was the opposite example? You've got a Minnesota, kind of a second home, Minnesota.
I got an amendment with the following language. Sellers shall have Patrick caulk and seal crack concrete joints to the best of his ability, and it may not be done till spring. To which we all immediately said, who's Patrick?
Patrick is not the buyer or the seller.
It's just the guy.
It's the seller's son.
Yeah. So...
And they had some other things that they put in there about the roof
chimney, flashing, and it was
causing trouble on the finance.
It is, and everyone means well, but from a lending perspective, we want the property to be in good condition.
Good and marketable condition. We don't want it in repairable, it's going to be in great condition after we do these repairs. So are we going to have to do an escrow holdback?
Yeah, we are. Because it's freezing cold up in Minnesota, and you can't fix chimneys in January.
Okay, so the deal is, if it's a weather-related item, most of the time, not all the time, we can hold back money from the transaction, and it's usually at least 120% of the contractor bidded amount. So let's say that it costs $1,000 to fix this chimney. We have to set aside $1,200. It gets held by the title company, and then after the chimney is fixed, then we use the money that's in the escrow account to pay the chimney repair guy, and then if there's any left over, we then disperse that to the seller.
So I'm just going to take the other side. The answer is please always consult with your lender before writing an amendment, but it's not to exclude things from the amendment because sometimes you want to hold the seller's feet to the fire. And we are happy to play bad cop.
Sure. Because if you put it in the amendment, we're probably going to make you do it before closing.
Absolutely.
If it's at all possible.
But if we can game plan that's just everyone's then rowing in the same direction.
That's right. It's all about teamwork and cooperation in the real estate transaction. By the way, I mentioned earlier in the show today that our denial rate, the percentage of loans that Accunet denies out of the last 1,200 purchase applications was only 6%. I was surprised at how low that was. It feels sometimes like more. But one of the reasons is because of our rock-solid pre-approval program.
Yes.
Which is gaining traction. Let's talk a little bit about that when we come back.
Right here on the Accunet Mortgage and Realty Show on WTMJ.
Don't just find a house, find your home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And David Wickert, and we're focusing in on just why it's so important to have that rock-solid pre-approval.
We've got a great example, a great success story really here, and it happens to be on someone that's a long-time loyal listener to the show. So she called up because she knows about the rock-solid pre-approval, and so we started going down that road. And, David, what were some of the unique items that we were able to address because we did our homework?
Yeah, ahead of time. So two things. One, we paid off a car loan just because the payment was kind of getting in the way of her swinging as much mortgage as she wanted to. She had the funds to do it. So that was thing number one. And then thing number two was I called up her financial advisor who's helping with the movement of money and everything, talked to Mark, and we set up distributions from her IRA that we can use.
She's a retirement age and she's not working.
Correct. Okay. That we can use to help her qualify for her mortgage. And we were doing that all before she had an address.
There you go. So it's about, just think about how much stress that would be, folks, if we were doing that, after she had an accepted offer. And the reason, of course, that we're talking about, we have to have you start taking some distributions from your IRA because that counts as qualifying income. And one of the things we always do when we're issuing a rock-solid pre-approval is we're measuring how much of your income are you using to make your monthly payments, not only on the house you're going to buy, but your other monthly debts. So in this case, it required boosting her income and reducing her other monthly debts so that she could afford the condominium that she wanted to buy.
In this example, too, part of doing the rock solid is actually figuring out what not to do sometimes as well. Because in this example, this borrower is going to be getting a payment from her sister because her sister's refinancing the family home that they all inherited, and our borrower is going to be getting this lump of money. And in the discussion here, part of good mortgage lending is never giving an underwriter more to chew on than they absolutely need. And so in her mind, she was like, well, I'm just going to use this money from my sister as the down payment. And I said, you know what? Behind the scenes, let's not draw attention to this money you're going to be getting.
Just because we would have to then document all the steps. Exactly. Where's the agreement of how much did you really own the asset that was being sold?
And so she has the funds to bring anyway, and then just in her own mind, she's just going to reimburse herself with the money from her sister. So
good job,
thank you.
But wait, there's more. Then she also listens to the show and knows that at Accunet Realty Advisors, we can put on our hat and find her a good real estate agent to work with on her search, and I was able to do that as well. She felt so good. She's got her financial advisor, her mortgage lender, and an excellent real estate agent all rowing in the same direction, and she has a place under contract now.
Yes.
Despite the tight market, right? We were kind of worried, is she going to be able to find a place? And sure enough, she's got it under contract, and as you said, David, using today's football analogy, we already started out on the 50-yard line.
Right.
Because we had all our homework done.
Heaven forbid we have a nice kickoff return.
Actually, you know what? I'm going to say that we were in the red zone already. Because all we really have to do for this particular customer is the appraisal.
Yes.
And that's all there is.
Not to sound like a broken record, but part of it is doing the rock solid pre-approval allows you to walk into a house on a Sunday afternoon and answer the question, do I want to have Christmas here? Mm-hmm. Because buying a house is the emotional, do I want to have family traditions here?
Yeah, you don't have
watch
to worry
Packer
about
games
it.
here.
That's right. And then if you wanted to know what your monthly payment was going to be, you could use our cool mobile application, which we don't talk about enough. You can get that right on your mobile phone.
These apps, yes.
And it's the green button if you go and visit our website at Accunet.com, and you can download the mobile app. It's got an awesome calculator on there where any home you're standing in, you can put in, here's the purchase price, here's my down payment. If it's less than 20%, it even figures out what your monthly PMI cost would be based on your credit score. Mm-hmm. You put in the condo association dues in this woman's case, property taxes, homeowners insurance, and you got yourself the thing that people want to know most is what's my monthly payment. Speaking of payments, David, what's happened with interest rates?
Yeah, we gave back a little bit this week, but at low overhead Accunet with 25% equity and all the right stuff, we can deliver 3.99% on a 30-year fixed rate mortgage with just 0.2 of a point. The APR is 4.05. And that is a total cost of $1,500.
That was what we would call low cost compared to a lot of lenders out there, like the nation's largest online lender. But and most banks, that's going to be normal closing costs at most banks.
You're saying we're not going to have a Super Bowl ad? Is that what you're saying?
We are not having a Super Bowl ad. I don't care if the Packers are in there or not. We are not having a Super Bowl ad.
Or if you're interested in the 15-year fixed, we can swing 3.375% with no points. APR is 3.4. That's with regular closing costs of just $1,100. And, the no-risk refi is here to stay.
You got it.
At the Accunet Mortgage. It's just, for those who are worried that their home isn't going to appraise, or that you just don't know. You know, your neighbor sold for X.
And you think, well maybe my house is worth Y, or maybe it's worth X plus $10,000.
Exactly. We're happy to take on the initial cost of that appraisal just to see if there's a winning game plan.
Well, let's clarify there, and I did put up a page now under the refinance tab at Accunet Mortgage. First, we have to make sure there is a winning scenario based on some reasonable estimate of the law. I mean, if you're underwater, we're not going to just spend the money on an appraisal to tell you how far underwater you are.
That'd be cruel.
But, let's put together the numbers, and then if they make sense, what we're doing is a desk appraisal on our nickel so that we know, are we in the game for making the numbers work. All right, so no risk refi, rock solid pre-approval, and a Packer victory would make for a great day. All you got to do to get started is click on the blue button for any of those things at Accunet.com. That's ACCUNET.com. That's all we got for this week, Steve. See you next week.
You got it. You've been listening to the Accunet Mortgage and Realty Show on 620 WTMJ. Straight ahead, we'll check in with Colleen Bolin in the WTMJ 24-hour newsroom.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors, and not WTMJ Radio or Scripps Media Incorporated.